Welcome to 2018, everyone. I'm Bryan Lebo, and this is your January market update video. Now, before we get into the normal monthly analytics, let's first look back on 2017 and see how it compared to 2016. First, let's look at sales. There's actually two ways of looking at this. First, take all the sales from last year and then look at the median. This comes to only $230,000, which compares to only $220,000 in 2016, which reflects a 4.5% appreciation rate. While that's one way to look at it, I prefer to look at it more realistically. We ended 2017 with a median price of $265,000. This compares to the end of 2016, where we ended the year with a median price of only $230,000. Now, this translates into a realistic 15% increase, which is about 4 times what normal is. Okay, next let's look at sales. We sold 32,771 homes last year, compared to 30,648 homes in 2016. This was an increase of 6.9%. We haven't sold that many homes since 2012, and remember what kind of market that was. It was nuts. Last, we ended the year with only 3,958 homes on the market. Last year, we ended the year with 6,125 homes on the market. This is a 35% reduction in inventory just from last year. Remember, this time last year, we were already talking about how low the inventory was. Now, later on in the video, I'll discuss the problem of inventory in a little bit more depth. Okay, now, before we get into the actual monthly update portion that we normally do, I wanted to touch base on the final GOP tax plan and how it affects us as homeowners. Essentially, there's 4 things that you need to know. First off is the maximum amount you can deduct for mortgage interest is now $750,000, which is down from $1 million. Now, the good news for some is that you're actually grandfathered in if you purchased your home before December 15th of last year. The greater truth is that this only even affects about 1% of our entire home sales. And frankly, if you're buying a $1 million+ home, losing a portion of the mortgage interest deduction isn't likely to even factor into your decision-making process. Next, you can no longer write off interest on a vacation home. However, if you rent it out for a portion of the year, you're allowed to offset the expenses as if it were an investment property. So, third, and a big one that nobody's really talking about, is the fact that you can no longer write off the interest on a home equity line of credit. This can't even be grandfathered in. So this is actually quite big for savvy investors who borrow money from themselves to either improve their home, start a business, or simply just use the equity as their own bank. While this doesn't necessarily affect many people, this will certainly hurt middle-class people the most, since they can use every deduction possible at this point. But the primary theme here is, honestly, folks, don't use your home as a bank to begin with. All right, last but not least, and for me the biggest issue, is the primary residence exclusion. This means that if you've lived in your home for 2 out of the past 5 years, then you're still good to sell it and pay no taxes on the profit. Up to $250,000 if you're single and $500,000 if married. This is huge because they were discussing going 5 to 8. All right. Now let's quickly get through our monthly update and wrap this whole thing up. First, we sold 2,420 homes last month. This was actually down from December of 2016 when we sold 2,505 homes. This looks bad on paper, but I'll explain my reasoning a little bit later. All right, next, which we discussed a little bit earlier, is median home price. As you can see, in a very surprising move, the median price actually went up last month to $265,000. This is the first time since I've even started tracking 6 years ago that the price went up in December. Crazy, but again, I'll explain what's going on later. All right, last but not least, let's check out the inventory levels. Like we stated earlier, we ended last month with only 3,958 homes on the market. Like I said earlier as well, this was a 35% decline from last year and over an 11% decline just from the previous month of November. So this is by far the most important metric for us to watch. Now, normally I do a wrap up of, what have we learned? For time's sake, I'm just going to cut to the chase. Inventory is killing us right now. The rest of the country is actually freaking out because they only have a 3-month supply of inventory. Meanwhile, here in Vegas, we have a 1.5-month supply of resale homes. Consider these numbers. Resale homes were up 6.9% last year. According to the last report I saw from Home Builders Research, new home sales are actually up 18.8%. So it goes like this. If you're purchasing a home anywhere near the median price, you simply can't find a new home. It just doesn't exist, man. So your only option is to purchase a resale home. Right now, those homes are absolutely vaporizing. Now, when you start looking at homes over, say, $500,000, the entire market changes for you. For most buyers, you're looking at resale homes built during the boom years, which are now starting to look a little dated and require some elements of remodeling. There isn't much out there inventory-wise, so most of the homes buyers are looking at are considered dated and undesirable, right? So at that premium price, buyers are willing to get less of a size home, but have it brand new exactly the way they want it to look. Buyers are essentially forced into purchasing a new home in the upper price ranges unless they're willing to remodel this other resale home that they're about to buy. This is why new home sales are flourishing again despite the obscene price difference. For many people like myself who would like to sell their home and have a new home, you look at the price and simply say, it's not really worth it. On the low end of the market, there aren't any new homes for sellers to even consider buying, so they have to stay put. Everything boils down to economics, supply versus demand. Demand is certainly there, and new home prices are at a very disproportionate ratio right now. New home prices are above boom level, and resale homes are still 20% below boom levels. Due to lack of supply, I think you're going to see hyperinflation occur this year. Resale home prices have to increase since the demand is still there and there's no supply. Once resale home values increase enough, sellers will be more apt to sell again and look to purchase these new homes. The key is how greedy will new home builders get and how much can they possibly charge for new homes before a backlash occurs, again like what happened in 2007. But until resale home prices start to increase, you're not really going to see sellers that are willing to put their homes on the market. The gap between the two is simply too high for most right now. And for many sellers, they're just barely recovered their original equity, so it's not as though they really have a lot of money to put down for their down payment, their pool, and everything else that goes into purchasing a new home. In the end, due to such poor supply, I really do believe that this year we're going to see an explosion in median home values. It's impossible to build new homes in decent areas for the median price anymore. Our inventory is already near half of what it was last year, demand is still steady, and upper end new home sales are flourishing. Unless your goal is simply to sell and skip town, my advice is to buy immediately before spring and summer rush and before that rush really pressures those prices upward. Remember, unless you're purchasing a less expensive home, don't be stubborn and wait out to get more for the sale of your home because you're simply going to spend more for your next home as well. And in the end, you just end up losing money. Well, that's it for this month, guys. Please be sure to click to subscribe. Have a wonderful month and a successful 2018.